its special focus on equity access, your daily insight on stock market developments and on developers in the Zimbabwean economy. A splendid evening it is to you. I'm Ibn Mabunda. Let's roll. Now, joining me for an interesting discussion tonight is Anesu Chumbumu, our resident analyst. Anesu, good evening and welcome to the show.
Hi Ben, how are you doing?
I'm very well, can't complain, should only get better.
All right, that's good then.
Splendid. Now, let's cut to the chase. Just a quick rundown of the issues that we are going to discuss tonight. The National Oil and Infrastructure Company expresses interest of upgrading the Feruka Pipeline in the second half of 2019. Meanwhile, Botswana offers Zimbabwe a credit facility towards the enhancement of productivity within the Zimbabwean private sector, while figures released by the central bank show a 14% growth in foreign receipts to $6.3 billion, while forex shortages persist. Anesu, let's get on with the ball. The National Oil and Infrastructure Company has expressed intention to actually upgrade the Feruka Pipeline in the latter half of 2019. But my question would be, looking at the fact that we're grappling with fuel issues in the country, could this perhaps enhance our fuel supplies in the country?
Well, the contention around fuel supplies in Zimbabwe is mostly to do with foreign currency. As we did discuss a couple of weeks ago, the minister actually mentioned that there is enough fuel in Zimbabwe, but then there was no forex for them to actually be able to access that fuel, which is settling within our storage tanks, and that then is being purchased by other foreign players, which ends up going to their respective countries. So now, with us not having foreign currency to actually purchase that fuel, to procure that fuel, then we won't have much of a difference in terms of our fuel supply in Zimbabwe, and with regards to the upgrade of the fuel pipeline. Now, the fuel pipeline is being upgraded mainly because of Sam Mundege's prior mention, or rather statement, when he was still Minister of Energy, that at the current level of uptake that we have been taking fuel, which was around about 4.4 million at that liters. Time, when 4.4 million liters at the time that he was minister, it wasn't very much viable for the government to actually start thinking about upgrading the pipeline. Now, with the way that the demand for fuel has gone up as of late, it is very much more likely that the capacity that pipeline was able to transport it has come to a place where it's no longer very sufficable. So they need to actually expand the pipeline for them to have more fuel moving in the pipeline, which then quickens the turnaround time as to fuel coming in from Beira into Zimbabwe.
But perhaps that's in the medium term. In the short term, we're saying over the weekend we had fuel queues, and it seems as though that the fuel crisis has not been sorted. So if at all we have got that much of an excess to actually spend on upgrading the Feruka Pipeline, why not?
Maybe they're spending RTGS dollars rather than the foreign currency. Because, I mean, foreign currency is the major problem why we cannot have sufficient fuel within the country. There is, within the country's usage. Now, there is fuel in Zimbabwe, according to the minister,
yes,
but we don't have foreign currency for us to actually purchase that fuel and for people to then use it at the pump.
Yeah, so perhaps we need to divert whatever reserve that would have put for the Feruka Pipeline and move it towards seeing to it that we've got enough foreign currency.
But then that'll only be for a short while. Whatever amount that these guys are going to be dealing with in terms of upgrading the pipeline, it probably is just going to buy the government just a few liters extra. I don't know exactly how much they're looking to spend on actually expanding the pipeline, but then whatever amount it is, because remember, we do spend about 20 million, or is it? Yes, 20 million a week on fuel. So I mean, if they're going to be spending 20 million on upgrading the pipeline, that's only 1 week's worth of fuel, and we haven't really circumvented the issue that we have to do with fuel shortages.
Now, I'm also aware that government has expressed commitment to also build a second pipeline that would feed into Botswana as well as feed into Zambia through to the DRC. How strategic is that for Zimbabwe?
Well, strategically speaking, it's a good space for Zimbabwe, as we would pretty much be the hub and distribution center of fuel for the southern region of Africa, where you'll find that almost every other country that is surrounding us actually being centrally located on the southern African side of the continent. We do find ourselves in an advantage where we could actually distribute to the 5-6 different countries that we can distribute.
Would that spell revenue?
It should spell revenue in terms
Forex?
of. Well, yeah, I mean, obviously, because we're going to be distributing to foreign countries, so those guys would need to pay us in foreign currency. But then the issue to do with how much foreign currency can be attained from that is not something that I could really be looking forward to, because I mean, for these guys, for most of these countries that are around us, they are actually looking to reduce their fuel import costs. So that means that they won't have to use their road or rail system that they had been using before. Now they have the pipeline. They stand a chance to actually reduce their costs. Because mind you, when we started using the Feruka Oil Pipeline, we were actually getting fuel at about 8.05 cents, and then it came down to about 6.25 cents, just because we started using the Feruka Pipeline. I do remember also around about that time, fuel prices, especially diesel prices, actually came off a little bit from the $40s that it had been chattering in. Rather, it wasn't $40, rather it was north of the $25. It came down to about $21 at that time. So you would find that these guys are looking to reduce their cost. So at their expense, as they reduce their cost, yes, we may be getting more foreign currency, but then the amount or amplitude of foreign currency that we need for a country to keep on functioning is not going to be very much sufficable. I mean, we need to be looking at more creative ways. We need to be looking at harsher terms and ways for us to actually get more foreign currency. I mean, we need to look at the real issues, which is dealing with the imbalance between your imports and your exports.
We have just introduced through the monetary policy statement a relaxation of the RTGS dollar against other currencies. Would that not perhaps be a positive step towards addressing the forex issues that we have? Because what that would do, unlike before where we had to deal with the 1:1 scenario, now we are sort of allowing market forces determine the prices of that. So that should perhaps enhance our forex, our ability to export. That should also revive those companies that were also now in the red. We're talking about cooking oil manufacturers, our miners, and the list being interminable. So perhaps with the introduction of the floating or relaxation of the exchange rate, we could be moving towards a position where we could narrow our trade deficit and allow us to have enough foreign currency reserves, and perhaps eliminate in the medium term these fuel shortages that we have in the country.
Well, that's a very good observation there. But then I'd like to put to you that we are looking to increase our foreign currency via relaxation of the exchange rate. But then as of late, the central bank actually put a bid and ask price of about 2.5, and that 2.5 rate is still more expensive than as compared to the other regional currencies, where you'll find that your rand is trading at about 14, your Pula is trading at about 11. It doesn't make sense for the other guys still, because economically speaking, we are not as better positioned or well functioning as these other countries around us that have much more dire exchange rates in terms of them being compared to the US dollar. Now, with us trading at 2.5, it is somewhat of a positive, but then the positivity of it is usually negated by the issue that we are still posing as a very strong currency where we don't have very good fundamentals within the economy. Because another thing we need to deal with, because I mean, for us to really talk about a strong currency, we need to make sure that our exports are beat. I mean, our exports have been showing some shakiness as of late. One of our major contributors for foreign receipts, which is the gold mining sector, has been coming off since October, and this has much to do with the issue that they've been complaining about in terms of their foreign currency retention rate, where it's at about 55%. They'll rather have it at a higher percentage rather than the 55% that they're dealing with. So now with them having to deal with the 55% retention rate, they're not being operable enough. They're not being efficient, okay. And they're having their costs run up because of a very strong currency that we are posing to have. And also this then brings them to a place where they'd find themselves in a position where they'll rather not operate, for example, your Riozim and stay domicile. Yeah, but then just focusing on gold, your Riozim did actually close their gold mining operations because of this one issue that is pretty much of a big contention between the government and the gold miners. So with them actually coming off within the last quarter of 2018, they did show some strength versus last year's production in terms of our January production numbers. But then I'm not expecting much from a growth in terms of their production rate as we go further into the year, because the same rate still is at the same level.
Okay, but I'd like to take you up on the currency issue. You do realize that at 1:2.5 plus or minus, that makes the RTGS dollar the most powerful currency in Africa.
Which is exactly what I'm saying, yes.
Now, on Friday, the president of the Consumer Council of Zimbabwe said he expects the rate to stabilize at about 1:20. Well, he wasn't exactly firm, he was a little bit speculative about it. But I think that if we could perhaps move towards that position, that would be good for the economy, because that would make our products more marketable and more lucrative.
We end up pushing more. We end up pushing more volumes. But then something that really rose up to my attention the other day was that, I mean, this 2.5 exchange rate, or rather whatever exchange rate that's going to be there. That means that even for me as an exporter, the raw materials that I need to import are going to go up also by 2.5. That the cost of me actually importing those raw materials, because there is a sentiment that the revenue authorities are actually gonna factor in the exchange rate. So that means whenever I'm going to be paying Zimra, I have to pay them 2.5 extra. So that means if I had $1,000 owing to them, now I have to pay them about 3.5. Now my cost has gone up, my cost of production has gone up. It could push my price up, but then with how our exchange rate would seemingly be very weak as compared to the rest of the currencies within the region, it could still give us a good number of foreign currency coming in because of the volumes that we should be ending up pushing.
Okay, talking about Forex, I'll link it up with the figures that we just got from the RBZ, of course, in the monetary policy statement. Figures show that our foreign receipts have scaled 14% to $6.3 billion, and yet we still have foreign currency shortages prevailing in the country. And at the same time, international remittances have declined by 19% to $1.4 billion. To $1.1 billion in 2018 against $1.4 billion recorded in the year 2017. Perhaps what could be the significance of that, or how are we, where exactly are we missing it? Because it seems as though that our figures seem pretty much good, but we still are not in a comfortable position in that sense.
Well, as good as they sound, or as good a percentage increase that we've experienced at that 14%, it's not going to be very much good for us, because I don't want to sound like a broken record, but then this is one of the hugest issues that we need to deal with for us to actually come to a place where we have good foreign currency reserves and also attract more foreign currency, is that we need to mitigate the issue between our exports and our imports, and our imports are far much more reaching rather than the export bill that we have. So that deficit between our trade activity then becomes the biggest problem. Now, even if we get the 6.5 billion that has come into the country, we are still facing the issue where we have actually imported goods in the same region of amount where we imported about 6.6 billion worth of goods. Now, with that being said, it can literally tell you how much we've pretty much spent all of the foreign currency that we've received from your remittances, from your exports and the like, and we still have much more that we've spent rather than we've actually made, because we then only exported about 4.5 billion worth of goods. So now that difference there becomes an issue. So if we do not deal with actually clamping down on our imports and making sure our exports go up, then we are going to be having a problem. Because I mean, we had a very good run in the gold mining sector in 2018 up until when the new finance minister Mthuli Ncube came in, and miners were very much expectant for a difference in policy in terms of foreign currency retention rate. They were looking forward to that, and I mean, prior to him being in office, they still pushed their numbers. They really did push their numbers. I mean, we did about 33 tons, in excess of 33 tons in 2018. So it's not like we do not have the work horses and the ability to actually push our production rates to as high as 40 tons as they have purported to actually target for 2019.
That's the 2019.
Yes. So if we do not deal with how we're going to encourage our exporters, then we are going to we're going to stay pretty much in this perpetual loss of our trade balance, because our exports are hugely funded by the gold mining sector, our tobacco and the like. But then tobacco seems to be in a fairer position because these guys are retaining about 80%, but that's for the traders that then export, but and then 35% for the farmer to the trader. So then the forex retention rate for gold miners is very critical. I would like to think so.
Well, I'm on to our next story, Anisu. Botswana offers Zimbabwe credit facility. This comes ahead of what has been called a Zimbabwe-Botswana bilateral commission. So the two permanent secretaries for the ministries of foreign affairs, Zimbabwe being represented by Mr. James Manzo, while Botswana is represented by Haimelwe Hoisemang. I hope I said that right. This is coming ahead of that. What is the significance of that? But before perhaps you can respond, remember that just recently the Afrexim Bank offered Zimbabwe credit facility worth $255 million. In December, South Africa denied Zim a credit facility worth over $1 billion. So what is the significance of these guys coming in at this point to offer so much?
All right. I think we also just need to realize that these bilateral relations that are beginning to come and take fruit have somewhat to do with the change in regimes that have come to light as of recently.
Right.
Ian Khama isn't the president of Botswana anymore. Masisi is, and he had pretty much differences with Ian Khama's policy views and how to help his southern counterparts. Now, Masisi seems to have an inclination towards the current government. We did talk about the pipeline that goes through to Botswana and Zambia. That was actually also discussed within the bilateral issues that they were talking about today in the morning. Now, with the 1 billion coming into the nation, the credit facility, at this moment in time, I think it's a good thing for the private sector, because we are looking at companies that are pretty much going to be filing for insolvency and bankruptcy, especially considering that we've had an exchange rate that has been floated where most of these companies' balance sheets were pretty much hedged on the 1:1 rate. Now that there's a floated exchange rate, most of their assets are going to be devalued by 2.5 or more, depending on what the rate is going to be where the rate is going to be pretty much stable at. But then as of now, most of these assets have been eroded by 2.5. That which is the exchange rate. Now, with that being said, that shows that the private sector now has some sort of support in terms of them being supported by the government for most of these companies not to get into such states where they have more liabilities rather than their assets, and this it's.
But how far would that go? I mean, we have many companies, listed companies, non-listed. What criteria would then be used in the allocation?
I mean, that leaves much to be answered, because I mean, we are not very sure in which sector really they are going to be really much interested in, because
the amount is said to be Zimbabwean private sector. So
yes, Zimbabwean private sector is pretty wide, because I mean, the private sector has the small to medium enterprises, has the big guys. So I mean, it depends on who really is going to be able to access that funding, that credit facility for them to stay afloat. But I suppose with the government trying to push a lot of foreign currency, they're going to support a lot of they're going to put a lot of support behind the guys that deal much with exports. But then if they ignore the rest of the populace in terms of the private sector, that means most of these companies are going to have to put more people out on the street if they actually then file for insolvency or bankruptcy, and that's going to push our unemployment rates up, production comes down. I mean, the chain reaction is pretty much endless. So you'll find that the 1 billion facility is a positive, but then how it is going to be used, which has been pretty much a huge problem for Zimbabwe in terms of implementation. I mean, implementation has been a very big problem. We've had very good policies that have been passed by the government. A lot of the times, a lot of economic policies, you can name any, and most of these sound very firm, sound very solid, and could have taken the nation somewhere. But then implementation has been a big factor and issue in terms of all of these policies. Now, implementation coming into the credit facility is going to be something that we need to really keep a very close eye on. Who is going to get some of that funding? Who's benefiting, and how much of an effect do they have to the contribution of the economy?
Okay, you're just going to take us through the stock market, but there's a question that I want to take you back to soon after, because you did mention the significance of the exchange rate weighing in on the companies that we have listed. But for now, you can go ahead and talk about the stock market and how the stocks have performed.
So as I scrolled right there, we do realize that the stock market was a little bit damp in the week opening today. Today was pretty much the fourth week in losses.
In losses?
Yes, in the stock market, recording losses on a week-on-week basis. Now today, the all-share index and the industrial index did come off by a similar rate, dropping about 0.5% of their points, which left all the all-share index points at 152.18 and the industrial index at 507.65 points. The mining index was very stable today. Not much movement in Bindura Nickel Company, which is the bigger weight in terms of that index. The top 10 index was on the negative as well, coming off 0.51%, almost similar to the other two indexes that I've mentioned earlier. Now, that drop has much to do with the cassava coming off by 1.5% and Old Mutual coming off by 2.23%, these two counters should show up among the rises and falls of the day. We did have about 3 rises and about 7 counters that were in the negative today. Now, Delta also came off 0.32%, and your Citco has also come off 0.93%. Now, just to look on a on a 5-day trend, the all-share index and the industrial index both are in the green, coming up 0.64%. That is on a 5-day trend, which would be measuring from this Monday back to Tuesday, which then gives us a graphical citation of what really happened throughout the 5 days that we've passed. So this does really show us that we have a positive gradient here, as we can see the 2 points from Tuesday to Monday are pretty much on a different spectrum now, which is your 0.64%. Now it is the line is in the red, much to do with today's negative influence on the graph. So as I mentioned earlier on, we had 3 rises at about 7, but then of the seven fallers of the day, we have the top 5, which is Simbisa, Old Mutual, Cassava, and Sitco. Now Simbisa used to be in the top 10 index bracket, but ever since Cassava then came in, those guys pretty much dropped down to become the 11th strongest company on the biggest company rather on the stock exchange. Now these guys dropped about 5.56% for them to settle at about 70.77 cents, while Old Mutual settled at 899.00 cents. Now I think this representation has somewhat a reflection on how the local parallel market, in terms of the exchange rate, we have been having a lot of talk around the exchange rate as of late. We do see that the exchange rate did come off today, settling at around about 3.8, coming from a strong 4, which was pretty much set on Friday when the interbank exchange rate was set at 2.5. Now today it did come off to about 3.8. I think that has much to do with the trades that actually happened in terms of RTGS money going into a foreign currency Nostro account at the rate of 2.5. Now there's still much to wait and see around that exchange rate, which should then give us a representation in terms of how we're going to be moving in terms of Old Mutual implied rate and the like. So now, because we do realize that the implied rate has an effect on the black market rate also. So the implied rate being with Old Mutual Zimbabwe being on the negative today, I wouldn't have expected anything more from the black market exchange rate today. RTG was in the positive today. They did come up 3.31% to 2.5 cents. I think that had much to do with the First Lady's meeting, much to do with the tourism sector having some support from the government, which then should give a little bit of confidence in that counter. Padenga, as we know, these guys seem to be rallying on a very good trajectory as of the beginning of the year. Yeah, pretty much that's what happened on the stock market today.
We did mention earlier the effect of the stock exchange, the effect of the exchange rate. Now, last year, actually towards the end of last year, there was a lot of hedging activities on the part of the investors, as everybody was looking to leverage themselves against the prevailing macroeconomic conditions. And while all the other markets on the continent were actually on a downward trajectory, we seem to be on an upward trajectory.
Yes.
Resultantly, domiciled companies in Zimbabwe that were on the S&P 500 were actually removed so as to bring balance to that index, because we were sort of distorting how the figures were being interpreted in that sense. That being said, my question is, with the floating of the exchange rate, remember we're coming from a 1:1 position, and all of a sudden we've got, at the moment we're sailing at about 1:2.5. And I will quote what the president of the CCZ said, that we could be perhaps on a path towards 1:20. What would happen to these companies if that were to be the case?
Okay, well, 1:20 may be pretty much hyperbolic, not knowing as to which exchange rate regime is going to be. He was insinuating such a kind of a rate at, because I mean, we have an interbank rate that is pretty much going to be maintained and somewhat controlled. It's a semi-fixed exchange rate by the RBZ, where you have your 2.5. Now 1:20 may get there if the black market deems it necessary, but then these guys are going to be selling. I mean, if they're going to be dealing at 1:20, they may as well run out of foreign currency very, very much quickly. Now, not dwelling much on his aspect of what kind of rate may come out in the long term.
But you realize it's not so much about what he said, but it's so
Yes.
much about the possibility of that actually happening.
Yes, which is what I was about to tell you now.
Right.
Now, the possibility of that happening, like I mentioned earlier on, that we have companies that will end up coming to a place where they have a net liabilities position, which is more liabilities rather than their assets, where their assets are devalued and their liabilities actually go up. And now this brings these companies in a place where they can actually file for insolvency or bankruptcy. Now, there are about $1.2 billion dollars worth of external loans that have been registered with the RBZ, and about $844 billion dollars worth of external loan drawdowns. So now you've got your $1.2 billion dollars of external loans and then $844 million dollars worth of external loan drawdowns. Now this comes up to about $2 billion, and that $2 billion needs for the RBZ to actually come into a place where they accommodate such companies that are in those positions, and make sure that these companies don't go into insolvency and have file for bankruptcy. On another issue, these guys may experience better revenues because of an exchange rate that is very much favorable to them by pushing up their volumes in terms of them actually exporting more because of the cheapness of our local currency. Now, with that being said, yes, we're gonna have that, but then their cost structures also are going to be adjusted, which is gonna pretty much put them in a place where they can plan better, but with the cost structures being adjusted upwards, that means their cost of production is going to go up, and which could actually reduce them, put them in a place where they do not produce as much. So so the two where they have the potential of earning more, they're actually being pulled in the opposite direction by a cost structure that may go up and cause their production levels to come down, and also because of inflation within the country that could come from that because of the cost structures going up.
Sounds more like an algebraic expression. In simple ABC, is the money of the investor safe?
The money of the investor may be safe if the RBZ helps out these companies.
Thank you, Anesu. Thank you, Zimbabwe, for watching. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website www.equityaccess.net. From Anesu and I, thank you and good evening.